This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. Welcome back to Candle Logic Trading, where we read the market and own the trade. In the last lesson, you learned the 5 most powerful single candlestick patterns, shapes that tell you who's winning the battle between buyers and sellers. Today, we level up. We're moving from single candles to multi-candle patterns, combinations of 2 or 3 candles that, together, tell a story that one candle alone never could. Specifically, we're covering the 5 strongest bullish reversal patterns. These are the formations that appear at the bottom of a downtrend and signal that the sellers are losing their grip. Spot one of these at the right time, and you could be catching the turn before the rest of the market even notices. 5 patterns, all bullish reversals. Let's break them down. Before we dive into the patterns, let's make sure the foundation is solid. A bullish reversal pattern is a specific candle formation that appears after a downtrend and suggests the trend may be about to flip from bearish to bullish. 2 things must be true for it to count. First, the market must already be in a downtrend. If there's no trend to reverse, there's no reversal. Second, the pattern itself must show a visible shift in control from sellers to buyers. That shift is what separates a reversal from random noise. One more thing, a reversal pattern is a warning, not a guarantee. Smart traders use it as a signal to pay closer attention, tighten stops, or prepare for a potential entry, and then wait for confirmation from the next candle or two. The pattern sets the table. Confirmation serves the meal. Keep that in mind as we go through each one. Pattern number 1, the bullish engulfing. This is the big one, probably the most well-known and most traded multi-candle reversal pattern in existence. Here's how it works. After a downtrend, you see a relatively small red candle. Sellers still in control, but their candle is modest. Then the very next candle opens below that red candle's close, but instead of continuing down, buyers storm in and push price all the way up, closing above the red candle's open. The green body completely swallows, or engulfs, the red body that came before it. That's the shift. The sellers had their turn, and then the buyers came in with something bigger and more powerful. It's a hostile takeover. The message is clear. Whatever selling pressure was there, buyers just overwhelmed it in a single session. The bigger the green candle relative to the red one, the stronger the signal. And like all reversal patterns, location matters. A bullish engulfing at the bottom of a sustained downtrend or at a known support level is far more meaningful than one floating in the middle of choppy action. Pattern number 2, the piercing line. Think of this as the bullish engulfing's slightly less aggressive cousin. The setup is the same, a downtrend, followed by a solid red candle. Then the next candle opens below the red candle's low. The sellers look like they're pressing their advantage, but during that session, buyers take over and push price up to close above the midpoint of the previous red candle's body. Not quite a full engulfing, but they've pierced well past halfway. Why does the midpoint matter? Because closing above it shows that buyers were strong enough to reclaim more than half of the ground the sellers gained. That's a meaningful show of force. If they only closed a quarter of the way up, that's not convincing. Past the halfway mark, that gets traders' attention. The piercing line isn't as dramatic as the bullish engulfing, so some traders look for extra confirmation. A strong green candle the following session to prove the buyers can sustain the push. But at the right location, it's a solid early signal that the downside is running out of steam. Before we continue, quick shout out to today's sponsor, ResumeZenith. If you're trading to build a better future, you still need to handle the present. ResumeZenith is the site I personally recommend to anyone job hunting or leveling up their career. Clean, professional resumes built fast. Check them out at ResumeZenith.com. Links in the description. And if you're picking up what we're putting down today, hit that like button, subscribe to the channel, and turn on the notification bell. We drop new lessons every Sunday, Tuesday, and Thursday, and the next lesson covers bearish reversals, the mirror image of everything you're learning right now. All right, 3 more patterns to go. Pattern number 3, the morning star. This is a 3-candle pattern, the first multi-candle formation that uses 3 bars instead of 2, and when it shows up at the bottom of a downtrend, it's one of the most reliable reversal signals you'll find. Here's the structure. Candle 1 is a strong red candle. The sellers are firmly in control, driving price lower. Candle 2 is a small body candle. It can be red, green, or even a doji that gaps down or opens near the close of candle 1. This small candle is the key. It tells you the selling pressure has stalled. The sellers pushed down, but they couldn't follow through. It's a pause, a moment of indecision. Then comes candle 3, a strong green candle that closes well into the body of candle 1. The buyers have arrived, and they mean business. The morning star gets its name because it appears just before the sunrise. In this case, the sunrise is the reversal to the upside: strong red, indecisive middle, strong green. That 3-act structure, conviction, hesitation, new conviction in the opposite direction, is what makes this pattern so powerful. Pattern number 4, 3 white soldiers. If the morning star is a polite invitation to consider the upside, 3 white soldiers is a declaration of war from the buyers. The pattern is exactly what the name suggests: 3 consecutive strong green candles, each one opening within the body of the previous candle and closing at or near its high. After a downtrend, this formation shows a complete and sustained shift in momentum. Session after session, the buyers are stepping in and driving price higher without giving ground. Here's what makes it work. Each candle should have a decent-sized body. No tiny indecision candles in the group. The wicks should be relatively small, especially the upper wicks. That tells you buyers held price near the high of each session, not letting sellers push it back down. And each candle's open should be within the body of the one before it, not gapping up wildly. Controlled, deliberate accumulation. Think of it this way: 1 strong green candle might be a bounce, 2 starts to look interesting, 3 in a row, each building on the last, each closing higher than the one before. That's conviction. That's a trend reversal you can start to believe in. One caution: if the 3 candles are extremely extended with very large bodies, the move might be overextended and due for a pullback. The ideal 3 white soldiers shows steady, measured progress, not a parabolic spike. Pattern number 5, the Bullish Harami. The word harami comes from the Japanese word for pregnant, and once you see the pattern, the name makes sense. A large red candle is followed by a small green candle whose entire body fits inside the body of the big red candle. The big candle is the mother, and the small one is tucked inside it. What's happening here? The first candle shows strong selling, but then the next session opens higher than the close and stays contained within the range of that big red bar. The sellers couldn't follow through. The buyers aren't dominant yet, but they've stopped the bleeding. The momentum has stalled. The Bullish Harami is the subtlest pattern on today's list. It's not as aggressive as the engulfing or as dramatic as the morning star. It's a quiet signal, a whisper that the trend might be shifting. For that reason, most experienced traders want confirmation, a strong green candle on the following session to validate the pattern before they commit. But don't underestimate it. At key support levels or after an extended sell-off, a bullish harami can be the very first hint that the bottom is forming. Let's bring all 5 together. The bullish engulfing. A large green candle completely swallows the previous red candle. Aggressive buyer takeover. The strongest 2-candle bullish reversal. The piercing line. A green candle opens below the prior red candle's low and closes above its midpoint. Buyers reclaiming lost ground. The morning star. 3 candles, strong red, indecisive middle, strong green. The classic dawn before the rally signal. 3 white soldiers, 3 consecutive strong green candles, each closing higher. Sustained buyer conviction, step by step. The bullish harami, a small green candle tucked inside the body of a large red candle. The quiet first sign that selling pressure is exhausted. And remember the golden rule from lesson 2. It still applies here, maybe even more so. Where the pattern appears matters as much as the pattern itself. A bullish engulfing at a major support level after a long downtrend is a high-quality signal. The same pattern in the middle of a choppy sideways range is just noise. Always ask, is there a trend to reverse? Is this pattern at a meaningful price level? Does the next candle confirm the story? 3 yeses. That's when you pay attention. Time for your homework. Open up TradingView. Links in the description. Pick any stock, crypto, or index, and zoom into a daily or 4-hour chart. Find at least one example of each of these 5 patterns. The best ones will be at the bottom of a visible downtrend. Take a screenshot and study what happened in the candles that followed. Did the reversal hold? Did the pattern fail? Both outcomes teach you something. And if you want this lesson as a clean, downloadable PDF with all 5 patterns and charts, just drop your email at candlelogictrading.com and we'll send it right to you. In the next lesson, we flip the script: bearish reversal patterns. The formations that warn you the rally is ending and the sellers are about to take control. Same framework, opposite direction. You don't want to miss it. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. That's it for today. Read the market, own the trade. I'll see you in the next one.